So today we're looking at yet another technology-based ETF from ETF Securities, which is ASX FANG. Now personally, out of all the sectors that we cover on this channel, I think technology is the most interesting one for me anyways, because I think there is so much room for innovation and it is always interesting to have a look at all these different types of ETFs. Now this ETF has done especially well over 2020. It was one of the top 5 ETFs of 2020 in terms of performance. Hey guys, my name is Fyzee and this channel is about finance and investing. Before we get into it, as usual, this video is not financial advice. I'm not a financial advisor. Please do some research on your end as well if you're looking to invest in this ETF. And if you want to check out the top 5 ETFs of 2020, there should be a link somewhere here as well. Go check it out and let's get into the video. So basically with ASX FANG, it is essentially giving us exposure to the highly traded next generation technology companies that are out there in the world. And these are essentially tech leaders of the tech space. So as you guys might know, the tech sector is the biggest sector in the United States. There is so much innovation that is possible, and these companies are trying quite hard to ensure that they can make those right investments to keep on innovating. And this ETF is basically giving us exposure to that. Now, it's very important to note that while a lot of us can say that technology is the future, this ETF is quite highly concentrated towards technology. It is basically 100% tech, which means that it is very susceptible to shocks and it is quite volatile, because if you have a look at it, and as we'll have a look at in just a second, this ETF is literally tracking only 10 companies. So each company has a rough exposure of 10%, making up the 100%. So you can see why this is so volatile, because it's only literally just 10 companies. Now in just a moment, we'll also have a look at the volatility and the share price as well of this ETF and how much it has performed so far. And the reason why this ETF is named FANG is because FANG is actually an acronym for Facebook, Apple, Amazon, Netflix, and Google. Not Microsoft though, there is no Microsoft in this ETF, just keep that in mind, but it also includes some other tech companies which we'll have a look at as well. Jumping into the benefits for the ETF, the number one benefit that we can see is the obvious, simple, low-cost access to top global innovation leaders listed on major US stock exchanges. So basically, with one trade, you can get access to all those US companies and without actually buying into them individually, which is of course going to save you the hassle, and it might also save you the brokerage cost as well. So that's basically the primary benefit of ETFs anyways. Benefit number 2 is the concentrated exposure to tech and tech-enabled household names as well. So this is exactly what we spoke about just then, where it is very concentrated towards technology, which means that it is kind of a double-edged sword, right? So if we believe that technology is going to do quite well in the future, then we're going to win quite big buying this ETF, hopefully, potentially, if technology does well. But on the other hand, if the valuations are very overvalued and it is very high priced, then we will also take on board all the risk and all the volatility throughout that time period. So it is kind of a double-edged sword, very high risk and very high return as well. And because the ETF is literally only tracking 10 companies, not 50 or 100 or 200 or even 500 as the broad market indexes do, you can see why it is so damn volatile. And number 3 is the exposure to world-changing megatrends such as digitization and electric vehicles. So of course, if you're a big believer of technology, it is definitely worth considering, along with some other tech ETFs as well. So let's get into the returns for this ETF. But before we do, if you have found any sort of value so far, please leave a like or subscribe. It really does help out with the YouTube algorithm. Let's get into it. So looking at the 1-year return for the ETF, it is sitting at 35.5%, which is actually quite good. And comparing that to the maximum return, the return has been about 69%, which is not bad either. If we just compare the bottom of the March period to now, the return has been more close to 92%, which is once again pretty insane because the overall market has not gone up by that much at all. This return has been roughly 2 to 3 times what the overall market has gone up by if you just look at the ASX 200 or the S&P 500 market. So since this ETF has obviously been listed since just over a year, we obviously don't have quite a lot of price data for the ETF. So let's just look at the index that this ETF is tracking and let's just cut to the chase and let's look how it's performed over the last couple of years. So the index which this ETF is tracking is the New York Stock Exchange FANG Plus Index. It was launched in September 2017, and before that the data has been back tested. So as you guys can see, this graph is stretching out to September 2014, and this is based on just back tested data. If the index existed back then, that's what the results would have looked like. So looking at this graph, we can see a range of colors and each color represents a different type of index. So we're going to go through this one by one and dissect each of these kind of lines and see what they mean. So this bright blue line, as you guys can see, this is the FANG Plus index, which the ETF is tracking, and you can see that it's really shot up recently. It's almost sitting at those all-time highs. So that's the blue index that we can see. And then the light blue is the S&P 500 Information Technology Index, right? So that is basically an index that's targeted more towards technology. And we can see that the black line is the Nasdaq 100 graph. And then lastly, at the bottom in the shallow gray, we have the S&P 500 index. And this is just a stock standard index that we're all used to. So we can see that, interestingly enough, the normal S&P 500 index has had the lowest return out of all these. If we combine a bit of technology into the mix, if we look at the black one, which is the Nasdaq 100, we can see that the return shoots up quite significantly. And if we look at the S&P 500 Information Technology one, it has gone up just slightly. So looking at these four graphs, we can kind of see that once we start to introduce more and more technology into the mix of companies and into the index, the return starts to increase quite a bit, right? So we can see that because FANG is literally only 10 companies, it's all tech companies, it has done the best out of all these indexes. And then if we add in, if we just look at the Nasdaq 100, Nasdaq 100 is 50% towards technology, and it has done quite well too. The S&P 500 index, which is a stock standard normal index, that has a technology weighting of about 25% only out of all the companies. So it has done the least well overall. So what we can deduce by seeing that is that once you add in more and more technology into the mix, the return starts to increase quite dramatically as compared to the FANG index, which is 100% tech. The return is the highest, right? And the other thing that we can notice as well is the fact that the more you diversify, the less your return starts to become. However, your risk is going to be lesser, which is good. However, the returns are going to be quite less. The upside is going to be less. Whereas if you compare it to the FANG index, we can see that 100% tech, the index has done so well, but it is also very volatile and it is not diversified at all. And this is not to say that diversification is bad. It is just to kind of tell you guys the implications of having too much diversified. You will be getting a stable kind of return, but the upside is going to be quite less. And looking at the graph, we can really see that since about February 2016, the separation from FANG and the other indexes started to happen, where the blue line just keeps on creeping up, and we can see that it nearly matched the other indexes in the March crash of COVID, of course. However, after the crash and the recovery that we saw, this ETF just smashed it out of the park. And this is mainly because the companies in that ETF benefited quite greatly when it came to the COVID crash, and because of work from home and all those tech services being used. So you can really see what kind of led to its gains. Now, one thing I want to also highlight when it comes to investing in this ETF is the fact that since it is 100% technology, tech can be seen as being overvalued at times, trading at those very high multiples and those companies at those ridiculous valuations. So of course, you do have the industry specific risk as well. But I hope that after looking at this graph, you can kind of see the other side of the picture where, everyone tells us to diversify and have a diversified portfolio. So, we spread our risk across all those different companies. But if you just look at a concentrated sector, if you just kind of target that sector, you can see the insane returns that you can get at the expense of more risk. So this is merely to highlight the other side of the picture as well, where if you didn't diversify, what sort of other benefits that you could get. Looking at the management fees for the ETF, it is 0.35% per year, which is about $35 per $10,000 invested. And it is not too bad considering the outperformance that we saw over that graph. It is quite a low fee to pay for that insane return that you could potentially get. But of course, past returns do not guarantee any future performance. Just keep that in mind. And the dividends are paid semi-annually as well. Now, fun fact guys, this ETF and other ETF securities ETFs as well are available to you guys to invest in completely brokerage free using a new brokerage platform called Perla, as you guys can see. So since ETF Securities forms part of their free brokerage, you can basically buy this ETF completely brokerage free, and as long as you hold it for over a year, you pay no brokerage. You do pay brokerage once you sell, but the fee is only going to be $9.50 for selling. So effectively, you're paying about $4.75 to buy and sell. Now, Perla is fully CHESS sponsored as well, which means that when you buy an ETF, you fully own it and you have 100% ownership of the underlying ETF. And the reason why I always bring this up and the reason why I always bring up Perla guys, because if you found this video valuable and you decided to buy this ETF, instead of paying ComSec $20 to buy this ETF or any other broker, you may as well buy it for $0 brokerage and just hold on to it for the long term. But of course, whichever broker you use is completely up to you. As long as you're making the steps to better your financial future, at the end, that's all that matters. But if you do want to check out Pearler, you can use my affiliate code, which is Fyzee, which is basically my first name, and you and I can both get a free trade as well. Looking at the top 10 holdings for the ETF, which is literally like all the holdings anyways, we have Twitter at about 11%, Apple, Alphabet, Facebook, Nvidia, Amazon, Tesla, Netflix, Alibaba, and Baidu. So lots of heavy hitting companies here that have done extremely well over the past 10-20 years. And just by this overall lineup, you can see the incredible amount of innovation that these companies have done and will continue to do moving forward. And for most of these companies, if you wanted to just have a look at their 10-year, 20-year price graph, you can really see an exponential move up. Most of these companies anyways, and it really shows you the power of technology and what these companies will continue to do. Just keep in mind that these aren't the only companies out there that are innovating. Of course, we have other companies like Microsoft and some other names that are not mentioned in this list. But since the theme of this ETF is FANG and some other innovative companies as well, some other names have not been added in. Looking at the different sectors for the ETF, we've got about 50% allocation towards communication, 30% to consumer, and about 20% to IT. So it's not very diverse. It is very kind of concentrated towards just those three sectors. And as you can probably predict, the country allocation is quite concentrated as well, with about 80% towards the US and about 20% towards China. And these are probably the two countries that personally I'm quite bullish on in the next 10, 20, 30 years. Other countries as well, but I think in that sort of time period, these two countries will hopefully keep on innovating and keep on trying to beat each other as rivals. Now, in terms of my portfolio, I have not added this ETF in. I'm still kind of considering it because it is quite weighted towards technology at the moment already. Nonetheless though, the potential of these 10 companies is absolutely insane, and let me know if you are looking to invest in this ETF at all, because I'd be curious to know what you think. So FANG was actually part of the top 5 ETFs of 2020 due to its insane performance. But if you want to go check out the other 4 ETFs of 2020 that were outperformers as well, you can check out this video right here. And guys, thank you so much for watching. Please like and subscribe, and I'll see you in the next one. Bye now. In that sort of time period, these two countries